Now, tomorrow we also have the unemployment report, which I think is going to be worse than expected. I can't be 100% sure about that. This is the daily chart. Can't be 100% sure that it'll be absolutely terrible, but I think it's going to be worse than expected. And in a bull market, one of the characteristics of a bull market is that bad news is rallied on in many cases in a bull market. Bad news is discounted. So you can really see that the mindset of people is what makes news good or bad, because in many cases, bad news that isn't favorable to a financial outlook like jobs or something like that for the United States, that could easily, if it's bad, be the excuse for the market to drop quite substantially. But when the market's really in a bull market, the mindset of the market doesn't really take the bad news. It's a perception that the bad news really isn't that bad. And because of that, the market can then move up and often will rally on bad news. So one way to read a market is to, particularly when it starts to be obvious that a trend is there, that any person would say, yeah, the trend is, as an example, up. When bad news comes out, the market can either completely discount it, which is common later in rallies, where the market's really getting stronger. It will discount bad news. And you're saying, boy, they're rallying even though this bad news came out. That's telling you should be in that bull market, because that's a market that doesn't hear the bad news. It doesn't register with them. Same thing true with a declining market. I'll take out my little pen here. A declining market that's doing this, when really good news comes out, sometimes they might have a little bit of a bounce, but in many cases, they just go right through the good news and they keep going down. So the bear mindset is overlooking or discounting the good news. It's discounting the good news. It's like, hey, things are great, numbers are great, and then the market continues to decline. So recently I talked a little bit about the buy the rumor, sell the fact indication. And I do really think that that's something that one of these days I'd really love to go into that a little bit and show you the brilliance of that. There are people who have had very important insights into whatever they study, right? And somebody could be medical, somebody could be some other science. But in this market world, there have been some people that have had really brilliant insights into the markets. And I just tend to think that this is one of the more brilliant insights into the market. It seems almost obvious, but it isn't obvious if no one had told it to you. It's not something that most people would have come up with. So one of these days we're going to talk about that a little bit, and I'd like to demonstrate, if I could, how that principle actually works in real time in the market. And in order to do that demonstration, we will need to have certain things in play that set this condition up. Many years ago, Martha Stewart had her company. I'm not sure what the name of it was. I can't remember of it. Can't remember it. But we were using the principle, buy the rumor, sell the fact, and so on, with her known set of conditions that she had, and it was just awesome how well it worked. And it was amazing. So thanks, Stu. Herman's here and he says, hello, David. I think bad news would keep the Fed away and markets could continue higher. Yeah. So in other words, bad news, the markets can rally on bad news, as we talked about, but that would keep the Fed from maybe intervening, from doing anything with interest rates and so on. And they've pretty much, at the last meeting, Friday's Jackson Hole, virtual meeting that they had, it was, they're just like, nope, we're good to go. Yep. Interest rates are going to stay low, all of that. When interest rates are low, housing prices go up. When interest rates are high, housing prices go down. Extreme interest rates like 18 to 20% interest rate only happen at the end of 30 and 40-year periods. I mean, really long periods of time have to go by. I've told you, I remember back in the 80s, many of you will remember back in the early 80s, interest rates were like 18 to 20%, somewhere around there. So if you were buying a house, you might be paying 17% interest on a 30-year loan. And therefore, housing prices were really low because interest rates were really high. And now, 30, 40 years from then, right? 1980s, 90, 10, yeah, 30 or 40 years later, the interest rates are very, very low and housing prices are very, very high. So that's a very strong fundamental backdrop for why housing prices are very, very high right now. Yes, you get a very low interest rate, but you will pay more for the house. And that's that kind of correlation where one thing acts one way and the other side of it acts the other way. The market has those kinds of things in it as well, where something is balanced off by something else. So the Fed keeping the interest rates low, that'll last for some period of time. I'll tell you this, if the Fed were to raise the interest rate by even 0.25%, the market would freak completely out. If they lowered it by 1/4, you would have a very sizable reversal. Even if they recovered beautifully from it, you'd have a freaked market if they even raised it by 0.25%. So keep in mind that the Fed and their position, just as Herman's saying, is going to be very important to the continuation of this market's general move on the upside.